Hi, everybody. I'm Bob Marone for Westchester Talk Radio. And once again, we are with our friends, Peter Lang and Richard Flahive of Hightower Westchester. Peter is a managing director and partner at Hightower, and Richard is a private wealth advisor and director of research and planning at Hightower. Today's focus will be on alternative investments. But before we get into that, can you brief us, you gentlemen, on how you construct portfolios and how alternatives fit into that equation? Peter.
Sure thing, Bob. Thanks as always for having us. We do enjoy spending time with you and Shark, of course. First off, the way we look at portfolios, where we start with a client is we are generally taking a longer term view for clients. Clients aren't asking us to invest money for a month or a week or 2 months. We're investing it for 5 and 10 years or longer, looking into their retirement or saving for something significant else in their life. So we start with, that longer term view. And then we kind of come with Richard's help and my other partner, Roman, we kind of form our macro view of the markets, right? Looking longer term at the economy, not at the short term gyrations of the market, but longer term at where we think the markets are heading, the economy, the growth of the economy or lack thereof. And all those other factors can kind of influence our decision. And then once we have that kind of built that macro view, we're then going, think of that as a top down. We're then looking at it from a bottom up. So now that we've formed our bigger picture, now we're trying to fill in, we view asset allocation as the most important part of what we're doing. So mixing stocks, bonds, alternatives, and cash, and then selecting within each sector where we think the best place to be is. And that becomes kind of, if you will, bottom up. So we're kind of starting at the top, bringing the bottom, and then we kind of meet in the middle to form our portfolios.
So what exactly are alternative investments, Peter?
Great. Well, to be very simple and, a little glib, alternatives are things that aren't stocks or bonds or cash, right? But more seriously than that, alternatives are things that, first off, will generally act differently than stocks and bonds, and that truly are different types of asset classes. And there are lots of them, right? I'll rattle off a bunch, but there are lots more that we're not going to touch on. So things like private equity, private debt, venture capital, hedge funds, real estate, precious metals, commodities, gold, managed futures, what we also known as CTA, commodity trading advisors. Even art and antiques theoretically could be alternative investments. And the typical way when you look at these things, they typically have relatively high minimums when you're looking at it on the private side, and we'll get into that a little bit more in a few minutes. And some of them, sometimes they tend to have low turnover, sometimes tend to have very high turnover. Again, depends on the exact type of investment. And these are the types of things when you read about, pension funds and endowments, the large endowments for the universities, they are all looking at alternative investments playing a fairly significant portion of their portfolios.
Richard, this is for you. Why do you use them in your portfolios?
Yeah, and Bob, good to see you. I think
always
looking at alternative investments, they have a place in client portfolios, and Benjamin Graham, who's known, across our industry as somewhat the father of value investing, has, once famously said, you buy, don't buy on optimism, buy on, arithmetic. So when we look at what investors are what their goals are, as Peter mentioned earlier, they're always looking for differentiated returns and potentially something that can do better than what we see on TV, right, in traditional public markets. And according to the American Investment Council, private equity in particular has provided those higher returns over public equities in both, bull and bear markets, over time. And I think the reason for those returns and the reason why we utilize them is particularly when you highlight private equity, that ability to go in when provide this backing to these private companies is you're allowing the equity holder to really provide that operational improvements, right, to the company, perform analysis of what's needed, right? Is it more information? Is it technology? Is it expertise? Is it leadership? So those are the various aspects on why we think private equity makes sense just from a 10,000 foot level. But there's also the pieces of diversification. and uncorrelated, exposures. They're very different. They're not mark to market, meaning every day the market closes, there's not a new valuation on these private investments. Oftentimes, they're valued on a quarterly or semi-annual basis. So when we look at the volatility of a portfolio, just from that perspective, it reduces it. And they're investing in different things. Whether it's like Peter mentioned, all those different styles and strategies, you have, very difficult access to them via public markets. This is where you access them for the most part. And then performance-wise, I mentioned it before. Public markets have had an amazing run over the last decade plus. But we looked at our investments, and Peter and I, just preparing for this, said, hey, what if you had a 5% weighting in private equity, which we do for some and most clients. It exhibits, even with the strength of the public markets, a very similar type return, but significantly less volatility. Now, if you take a normal market environment where, public equities aren't annualizing, 10, 15, 20% over the last couple of years, you're probably going to see a lot of more upside performance when you add these in. The other piece is yield. We mentioned, fixed income. We view fixed income with little yield or interest at all, as rates are so low. So when we talk about private debt, middle market lending, some of these other differentiated strategies, private credit, they offer a bit more in the way of yield. And for some of the older folks in retirement, this can be a nice income generative strategy. But I would say the biggest thing why companies and why we like to use private companies is companies are staying private longer. We're seeing, the short-term nature of the markets and just this 24/7 news cycle. CEOs are under the gun to perform on a relatively short basis when, as we all know, anything good takes a while to build. So you're seeing really, really quality companies staying private longer. And again, we want to access those. So
what types of vehicles would one invest in? And I'll refer this to Peter also. If you could give us a little hint, what are the units of measure, or are they all different for these kinds of investments? Peter?
Sure. Well, first off, building on what Richard said, there are, again, getting back to a very flippant answer, there are two types of alternatives, liquid and illiquid alts, right? Liquid alts being things that are daily liquidity, like stocks, bonds, cash, mutual funds, ETFs, right? All of those types of investments have what we call daily liquidity. So there are alternative investments that offer that daily liquidity, such things as, any type of alternative investment in the form of an ETF, be it a gold ETF or real estate funds or any of those kind of things have that daily liquidity.
Right.
And then there are the illiquid formats, right? So think of things like hedge funds, private equity funds, venture capital, other things like that have certain liquidity constraints, right? Meaning you can't sell them, you can't buy them today and sell them tomorrow. You may have to buy them in a month from now and can't even sell them for 3 or 6 or 9 months from the date you purchased them. So they may have, typically they have monthly or quarterly ability to purchase and typically quarterly or semi-annual ability to sell. So that becomes the first difference in constraint. It doesn't make the ones that are liquid or illiquid better or worse than the others. It's simply just different ways of accessing them. And then the second way to look at it is obviously a liquid alternative investment is open for anybody. Anybody who can invest in it, who can buy a stock, can buy an ETF, can buy a mutual fund, can buy any of the liquid alternatives. For illiquid alternatives, there generally are some, I'll call them barriers to entry. And it's not necessarily a barrier to entry. These are guidelines issued by the SEC that dictate for these illiquid investments that the investors who are investing them need to be, quote unquote, more sophisticated. And they have 2 levels of, I'll call it sophistication. One is called an accredited investor, and the other one is called a qualified purchaser. A qualified purchaser simply has a net worth of greater than $5 million. Liquid net worth of greater than $5 million. So they can't have a vast real estate holding and be considered a qualified purchaser. They actually need to have liquid net worth. And then the other are accredited investors. Generally, accredited investors have to have $1 million or more of net worth and or income, individual or joint income in excess of $200,000 for the past, I think it's either 2 or 3 years. So those those are established not by Hightower or by Richard or Peter. That's established by the SEC, and we have to follow those guidelines for entry.
You're listening and watching Westchester Talk Radio. We are here today with Peter Lang and Richard Flahive. We're talking about alternative investments, and we move now to Richard. Richard, how have you used alternative investments historically?
Sure. And Peter, we've definitely kind of mentioned it a bit throughout the call so far, but we've generally, historically had some exposure to alternative investments, in the past, in some way, shape, or form. Not saying we've had it every year, every month, or every different strategy, certain, time and place, right? Like I mentioned before, private debt, middle market lending, all those types of strategies with yields and rates being so low, that's come to the forefront. Private equity, I think, has always kind of been on our radar. And we've used them for a number of clients that can qualify, like Peter mentioned. But I think the most important thing is we've used them for clients, and Peter mentioned this, who understand the risk and reward. It's not for everyone. Despite the fact that they might qualify based on those metrics Peter mentioned, doesn't necessarily mean it's a fit for them, either from a liquidity standpoint, right? Or maybe they just don't feel comfortable with the complexity of it. Because as we all know, I mean, you might have watched Billions, the show, or something like that. a little Hollywood there, but I think, there is a level of that is true, right? Where there are some, in terms of regulations and how often, hedge funds are looked at very differently and monitored very differently than mutual funds and ETFs. So we take that in mind. But, historically, when you look at, we've been adding more and more to client portfolios in this space. And that's really because of just where the markets are. So you look at like last year, for example, markets dropped, 30-35% in March. I would say our managers were down, barely double digits, somewhere in that 10 to 15% range. And then when you look through, I was just looking at some of the numbers before this, through the end of September, end of August, give or take, the markets were flat last year, essentially getting back to their watermark. And the private equity funds, the fact that they didn't draw down as much, they were up, single digits, 5, 6, 7%. So, I go back to that performance piece. It makes sense to have them. Gold is something we added to models and client portfolios back in probably the end of 19. And, a lot of the, checking the boxes, right? Low rates, geopolitical uncertainty with the election coming up. The dollar was, basically trending sideways. So, that's a time when, okay, hey, gold makes sense, right? And inflation, when's that coming, right? So that's when we use it, something like gold. Managed futures, which is a very uncorrelated, if not sometimes negatively correlated to public equities. And basically all these are futures and options, currencies, anything but really stocks, right? They were up almost 5%, our specific fund in March of last year. I mean, you're talking about a 40% difference in return there. So we have them for a rainy day. And then just exposure to non-traditional markets. Like Peter mentioned before, we're not buying necessarily any art out of the Louvre here, but you think of startups and you think of just differentiated strategies that you can get exposure to in these sectors and with these funds. And that's where we can add value for clients. And we've done so in the past. But like I said before, we keep in mind the liquidity aspect, or illiquidity, I should say, what the exposure amount is, right? We would probably never have anyone significantly, over 50% exposure to something as illiquid as these investments can be. But we've used them in a variety of different ways. It really is time and place, like I said before.
Before we move on, thank you very much for that, Richard. Before we move on to closing thoughts, I mentioned this earlier. How are these? Now, I realize exchange traded funds and other funds and different things like that, they're reflected in a statement in units of numbers of bonds or thousands of dollars invested face value, shares. How are some of these securitized? I'm thinking of the client that's looking at this and wonders, when he or she looks at their statement, what will they see? How are these securitized? What do they look like if I buy gold, or if I buy some art from the Louvre or a fund for the Louvre? Richard, you can take that one.
Sure. And I think Peter will attest to this. We ask almost any of our managers, hey, how is this going to be reported? Can it sit on the Fidelity platform or one of these custodial platforms? And that's something we would like. It's not a be all end all factor for us. And we've gone direct to some of these things, but I think just the way things are moving in terms of being able to cater to, let's say, the RIA industry or the retail investor, so to speak, they want to be on these custodial platforms. They want to be able to show their performance because why not, right? They've done a good job. But not, to your point, Bob, not everything can sit on a statement. Artwork,
yes, I
not
know.
so much. So.
Hey, I go back to the days when we used faxes and you had a pile of faxes that you tried to put on a statement somehow. So I understand. These are sophisticated investments. Thank you. Let's move on. Peter, let's start with you first. And then Richard, you can chime in. Any closing thoughts?
Sure. So, this has been a great conversation to have, but to us, it all starts with asset allocation, right? And the premise behind the asset allocation is that one, you're never going to time the markets perfectly. So you're never going to buy, this asset class A on the day that it hits its absolute low and sell it a week, a month, a year later when it hits its absolute high, right? So first off, it's asset allocation, and which is, kind of also a general belief that no one asset class is necessarily better or worse than any others. And the premise behind asset allocation is that you're mixing, in our case, about 10 to 12 different distinct and disparate asset classes together to form kind of a better portfolio, one that's smoother, right? As Richard said, our portfolios back in February, March of last year were down significantly less than the S&P because they were diversified. We had things that were zigging when other things were zagging. And it's not always also about past performance, right? We look at past performance when we look at asset classes and investments, but we're also looking more importantly at what we think the future holds for said asset class or said investment, right? The past gives us an idea of how they did in certain markets in real time because we can look, but we want to say, well, was it an anomaly that they performed really well or really poorly in a given short time period? Or is it more indicative of what the investment is? So we're looking at all of these things together and kind of mixing and matching them together and kind of weaving a portfolio together with all of this stuff. And as Richard said, alternatives add a level of diversification to a portfolio that you don't get just having stocks, bonds, and cash in there.
Thank you. Richard, your final thoughts, please.
Yeah. And I mentioned before not being afraid of alternatives. They're obviously complex, but our job, and this falls on our shoulders a lot too, is explaining to clients what they are and how they operate. Not always the easiest thing because these are differentiated strategies. But again, understanding what they do and understanding that they can add not just diversification or less volatility, but alpha, right? And just excess return. And I think for us, talking to clients, you have to size it appropriately. You have to make sure it fits for that specific client, what their goals are, just like anything. But I mentioned this last fact, and this is according to JP Morgan and their guide to the markets. They produce, every quarter, these various presentations and slides. And the one thing with U.S. domestic public companies is they've really been, and I said it before, they're lower now than they've ever really been historically. So there are only about 4,000 or 5,000 public companies in this country. When you rewind 20, 30 years ago, it was much different. Double, triple that, and that just goes to show you, like I said, private companies are staying private longer, and there are a significantly more amount of private companies than there are public companies. So as fiduciaries, when we look at the opportunity set, we're kind of obliged to take a look at these things. And more often than not, they make their way into the portfolio. So, and for good reason.
Well, this has been a wonderful conversation, and it expands for Hightower Westchester clients. It avails them to all of the investment possibilities. Richard Flahive and Peter Lang, thank you very, very much. Folks, they are with Hightower Westchester. Thank you. I'm Bob Marone for Westchester Talk Radio. Thank you for listening.
HighTower Westchester is a group of investment professionals registered with HighTower Securities LLC, member FINRA and SIPC, and with HighTower Advisors LLC, a registered investment advisor with the SEC. Securities are offered through HighTower Securities LLC. Advisory services are offered through HighTower Advisors LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other information contained in this research is provided as a general market commentary. It does not constitute investment advice. HighTower Westchester and HighTower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This podcast was created for informational purposes only. The opinions expressed are solely those of HighTower Westchester and do not represent those of HighTower Advisors LLC or any of its affiliates. HighTower Advisors do not provide tax or legal advice. This material was not intended or written to be used or presented to any entity as tax advice or tax information. Tax laws vary based on the client's individual circumstances and can change at any time without notice. Clients are urged to consult their tax or legal advisor before establishing a retirement plan.